I have been doing this for over 30 years. I have made billions of dollars by being early to ideas that the rest of the market eventually recognizes. And right now, I am making one of the biggest bets of my career on a sector that most investors have completely written off. This sector has been crushed, down 40, 50, 60% from its highs. In some cases, hedge funds have abandoned it. Retail investors hate it. The financial media barely mentions it anymore. When I tell people what I am buying, they look at me like I have lost my mind. But that is exactly when I get excited, because the best returns I have ever made came from buying what everyone else was selling, from having the conviction to act when fear was at its peak, from recognizing that the market had overcorrected and that valuations had become completely disconnected from fundamentals. The sector I am loading up on before 2020, 7 is energy, traditional energy, oil and gas companies, the companies that power the global economy and that the market has left for dead. Let me explain exactly why I think this is the opportunity of the decade first. Let me tell you how I think about investing. I am not an idealist. I am not a politician. I do not care about narratives or what people think should happen. I care about what is actually going to happen. I care about supply and demand. I care about cash flows. I care about valuations. I follow the money, and when I follow the money in energy, I see a setup that I have rarely seen in my career. A setup where the fundamentals are strong, the valuations are absurdly cheap, and the sentiment is so negative that any positive surprise will send these stocks dramatically higher. Let me start with the demand picture because this is where most people get it wrong. The mainstream narrative is that oil and gas demand is about to collapse. Electric vehicles are taking over. Solar and wind are replacing fossil fuels. The energy transition is happening faster than anyone expected. Fossil fuels are stranded assets that will never recover. This narrative is wrong, not because the energy transition is not happening. It is, but because the timeline and magnitude that people expect are completely unrealistic. Here is the reality. Global oil demand hit a record high last year, not a decade ago, last year. And it is projected to hit another record high this year and another one next year. The International Energy Agency, which has consistently underestimated oil demand, is projecting that demand will continue growing through at least 2030. How can this be? How can demand be growing when everyone is talking about electric vehicles and renewable energy? Because the world is a lot bigger than the United States and Europe. 3 billion people in Asia are industrializing. They are building roads and bridges and factories. They are buying cars and motorcycles and air conditioners. They are consuming more energy every single year. China added more oil demand last year than all the electric vehicles in the world displaced. Think about that. Despite all the growth in EVs, despite all the investment in renewables, despite all the government mandates and subsidies, oil demand still grew because the developing world is consuming more energy than the developed world is conserving. And this is not going to change anytime soon. India's per capita energy consumption is 1/10 of America's as India develops. As its middle class grows, its energy consumption will increase dramatically. The same is true for Indonesia, Vietnam, Bangladesh, Nigeria, and dozens of other countries with young, growing populations. Aviation is another demand driver that people underestimate. There are no electric airplanes. There will not be electric airplanes for decades, if ever. The energy density of jet fuel cannot be replicated with batteries given current or foreseeable technology. As global travel increases, as the middle class in developing countries starts flying for the first time, jet fuel demand will grow substantially. Petrochemicals are yet another demand driver. Plastics, fertilizers, pharmaceuticals, synthetic materials, these all require oil and gas as feedstocks. As the global economy grows, petrochemical demand grows. There is no substitute. You cannot make plastic from solar panels. So demand is not collapsing. Demand is growing, and it will continue to grow for at least the next decade, probably longer. Now, let me talk about supply, because this is where it gets really interesting. The oil and gas industry has been starved of capital for a decade. After the shale revolution flooded the market with oil in the mid-2010s, Prices crashed, companies went bankrupt. Investors lost billions. The industry became toxic to Wall Street. Then came the ESG movement, environmental, social, and governance investing. Suddenly, it was not just risky to invest in oil and gas, it was immoral. Pension funds divested, endowments divested, banks stopped lending, private equity stopped investing, the capital spigot was turned off. The result is a massive underinvestment in new supply. The industry is not drilling enough new wells. It is not developing enough new projects. It is not replacing the production that naturally declines every year. A typical oil well declines 5 to 7% per year. If you do not drill new wells, production falls. Global oil and gas capital expenditure is down 40% from its peak, 40% at a time when demand is hitting record highs. This is a recipe for a supply crisis. We are already seeing the effects. OPEC has spare capacity, but it is concentrated in a few countries, primarily Saudi Arabia and the UAE. Outside of OPEC, production growth has stalled. The U.S. shale boom is maturing. The best drilling locations have been exhausted. Productivity gains are slowing. Production is plateauing. And here's the thing about oil and gas supply. You cannot turn it on overnight. Developing a new oil field takes 5 to 10 years. Building offshore platforms takes even longer. The projects that were not funded in 2018 and 2019 and 2020 are not producing today, and they will not be producing in 2027 either. So we have growing demand and constrained supply. What does that mean for prices? It means prices are going higher, maybe much higher. I am not making a wild prediction here. I am just following the math. If demand grows at 1 million barrels per Dalton Y annually, which is the historical average, and supply cannot keep up, prices rise to balance the market. That is how commodity markets work. And I think the price increase could be substantial. Oil at $100 per barrel is possible. Oil at $120 or $140 is possible in a supply disruption scenario. The market is not prepared for these prices. The stocks are not priced for these scenarios. Now let me talk about valuations, because this is what really gets me excited. Energy stocks are absurdly cheap. Not just cheap relative to history, not just cheap relative to other sectors. Absurdly, ridiculously cheap on an absolute basis. Let me give you some specific examples. Major integrated oil companies are trading at 6 to 8 times earnings. 6 to 8 times the S&P 500 trades at 22 times earnings. Technology stocks trade at 30 times earnings. Energy stocks trade at 6 to 8 times at. These valuations, you do not need anything good to happen. You just need nothing bad to happen. If oil prices stay flat, if production stays flat, if nothing changes at all, these companies will earn their entire market capitalization in cash flow over the next 6 to 8 years. That is an extraordinary setup. But it gets better. These companies are generating massive free cash flow at current prices. Cash flow that they are using to pay dividends, buy back stock, and pay down debt. The dividend yields on major energy companies are 5, 6, 7%. The buyback yields add another 3 to 5%. You are getting paid 8 to 12% per year to wait for the market to recognize the value. Compare that to technology stocks that pay no dividends and trade at 30 times earnings. Compare that to bonds that yield 4 or 5%. Compare that to real estate that yields 3 to 4%. Energy stocks offer dramatically better value than almost any other asset class. And the companies themselves are in the best financial shape they have been in decades. They learned from the last bust. They cut costs. They improved efficiency. They paid down debt. The balance sheets are fortress strong. These companies can survive oil at $50 per barrel, at $70 or $80. They are printing money. Let me give you some specific numbers on free cash flow yields. Exxon is generating a free cash flow yield of around 10%. That means 10% of the company's market cap is being generated in cash every year. Cash that is being returned to shareholders through dividends and buybacks. Chevron is similar, 10% free cash flow yield, a dividend yield over 4% active share buybacks, reducing the share count. ConocoPhillips, the largest independent exploration and production company, is generating a free cash flow yield of 12 to 14%. 12 to 14% at current prices, not at $100 oil. At current prices, these are not speculative bets on small companies. These are the largest, most established energy companies in the world. Companies with decades of operating history. Companies that have survived multiple oil price cycles. Companies that will be around for the next 50 years. And they are trading at valuations that imply the market thinks they are going out of business. The market is wrong. And when the market is wrong by this magnitude, fortunes are made now. Let me address the obvious objection. What about the energy transition? What about climate change? What about the long-term decline in fossil fuel demand? These are legitimate concerns. I am not dismissing them, but they do not change the investment thesis for the next 3 to 5 years. Even in the most aggressive energy transition scenarios, oil and gas demand remains substantial through 2040. The world cannot transition to renewables overnight. The infrastructure does not exist. The technology is not ready. The economics do not work in many applications. And in the meantime, the existing oil and gas assets will generate enormous cash flows that will be returned to shareholders, cash flows that will more than justify current valuations. Think about it this way. If an energy company trades at 6 times earnings and generates enough cash flow to return its entire market cap to shareholders over the next 6 years, what happens after that? Even if the company then goes into permanent decline, you have already gotten your money back. Everything after that is pure profit. This is the margin of safety that Benjamin Graham talked about. When you buy an asset at such a low price that even a bad outcome still makes you money, you have stacked the odds overwhelmingly in your favor. And I do not think the bad outcome is likely. I think oil and gas demand will surprise to the upside. I think supply will disappoint. I think prices will be higher than the market expects. And I think energy stocks will dramatically outperform over the next 3 to 5 years. Let me talk about specific opportunities within the energy sector, because not all energy investments are created equal. My largest positions are in the integrated majors, Exxon, Chevron, and their European counterparts. These companies have diversified businesses that span exploration, production, refining, chemicals, and retail. They have massive scale advantages. They have the financial strength to weather any downturn, and they are trading at valuations that provide tremendous downside protection. The integrated majors also have the best positioning for the energy transition. They have the capital to invest in carbon capture, hydrogen, biofuels, and other low-carbon technologies. They have the engineering expertise to execute complex projects. If the transition accelerates, they will adapt. If the transition stalls, they will profit from higher fossil fuel prices. Either way, they win. I also own significant positions in independent exploration and production companies. These are more levered to oil and gas prices. When prices rise, their earnings and cash flows increase dramatically. They are riskier than the majors, but they offer more upside. Within the independents, I focus on companies with the lowest cost production, companies operating in the Permian Basin in Texas and New Mexico, companies with strong balance sheets and disciplined management teams, companies that can thrive even if oil prices stay flat. I am avoiding companies with high debt loads. I am avoiding companies in high-cost basins. I am avoiding companies run by management teams that have a history of destroying shareholder value through overexpansion and poor capital allocation. Not all energy companies are created equal. I also have positions in midstream companies. These are the companies that own the pipelines, storage facilities, and processing plants that move oil and gas from production sites to refineries and end users. They collect fees based on volumes, not prices. Their cash flows are stable and predictable, and they trade at high single-digit dividend yields. Midstream companies are particularly attractive for income-oriented investors. The dividends are substantial and well covered by cash flow. The businesses are essential infrastructure with high barriers to entry, and the valuations are modest relative to the quality of the assets. I have smaller positions in oilfield services companies. These are the companies that provide the equipment, technology, and services that oil and gas producers need to drill and complete wells. When activity increases, their revenues and earnings grow. They are highly cyclical, but they offer significant upside. If the energy market tightens, the services companies have been through a brutal cycle. Many went bankrupt or restructured. The survivors are leaner, more disciplined, and better positioned for the next upturn. When oil prices rise and producers increase drilling activity, the services companies will see substantial earnings growth. Let me also talk about what I am not buying. I am not buying renewable energy stocks, solar, wind, battery storage. I think these industries have good long-term prospects. But the valuations are too high and the near-term outlook is challenged. Rising interest rates have increased the cost of capital for capital-intensive renewable projects. Supply chain problems have increased equipment costs. Competition has intensified, compressing margins. Eventually, renewable energy stocks will be attractive, but not now. The risk. Reward is much better in traditional energy. I am not buying energy stocks with weak balance sheets. The companies that loaded up on debt during the last boom are vulnerable if prices decline. Even though I expect prices to rise, I want to own companies that can survive any scenario. Fortress balance sheets are essential. I am not buying energy stocks trading at premium valuations. Some energy companies trade at higher multiples because of perceived growth opportunities or unique assets. I am skeptical of paying premiums in a cyclical industry. I want the margin of safety that comes with buying at low absolute valuations. Let me discuss the risks to this thesis, because there are real risks that could cause this investment to underperform. The biggest risk is a global recession. If economic growth stalls, if demand declines, oil prices will fall and energy stocks will decline. I think a severe global recession is unlikely given the strength of the labor market and consumer balance sheets. But it is possible. To mitigate this risk, I focus on companies with low-cost production and strong balance sheets. Companies that can remain profitable even at $50 oil. Companies that can survive a downturn and emerge stronger on the other side. And a third risk is a faster than expected energy transition. If electric vehicle adoption accelerates, if renewable energy costs fall dramatically, if governments impose aggressive carbon pricing, demand for fossil fuels could decline faster than I expect. I think this risk is overblown. The energy transition is happening, but it is happening slowly. The infrastructure investments required are massive and will take decades. But I could be wrong. To mitigate this risk, I focus on companies that are investing in low-carbon technologies and that have the financial flexibility to adapt. A third risk is political interference. Governments could impose windfall profit taxes on energy companies. They could restrict drilling permits. They could mandate renewable energy purchases that disadvantage fossil fuels. Political risk is always present in the energy industry. This is a real concern, particularly in Europe, where governments have been hostile to fossil fuels. I focus my investments on US and Canadian companies, where the regulatory environment is more favorable. And I note that even hostile governments eventually recognize that they need reliable energy supplies. A fourth risk is poor capital allocation by management. Energy companies have a history of destroying shareholder value by overexpanding during booms and overpaying for acquisitions. If management teams revert to their old behaviors, shareholder returns will suffer. This is why I focus on companies with disciplined management teams and strong corporate governance. Companies that have committed to returning cash to shareholders rather than empire building. Companies where management's compensation is tied to shareholder returns. Despite these risks, I believe the risk-reward in energy stocks is asymmetric. The downside is limited by already depressed valuations, strong balance sheets, and substantial cash returns. The upside is significant if oil prices rise or if the market simply re-rates energy stocks to more reasonable valuations. Let me share some thoughts on timing and positioning. I have been building positions in energy stocks for months. I am not trying to time the bottom perfectly. I am dollar cost averaging into positions, buying more when prices decline and adding on weakness. I expect this trade to play out over the next 2 to 3 years, maybe longer. I am not looking for a quick flip. I am positioning for a multi-year repricing of energy assets. The catalyst that will drive the repricing is simple: cash returns, as energy companies continue to generate massive free cash flow and return it to shareholders through dividends and buybacks. The market will eventually recognize the value. Stock prices will rise to reflect the underlying cash generation. We may also see external catalysts: a supply disruption from geopolitical tensions, an unexpectedly cold winter that drives natural gas prices higher, an acceleration in global economic growth that increases energy demand. Any of these could trigger a sharp repricing of energy stocks. But I am not counting on external catalysts. The internal catalyst of cash returns is sufficient. Patience is required, but the math will eventually win. For individual investors looking to implement this thesis, I have a few suggestions. First, size the position appropriately. This is a high-conviction idea, but it is also a contrarian bet that could take time to work out. Do not bet the farm. A 10 to 15% allocation to energy stocks is appropriate for most portfolios. Second, diversify within the sector. Own a mix of integrated majors, independents, and midstream companies. This reduces company-specific risk and provides exposure to different parts of the value chain. Third, reinvest the dividends. Energy stocks pay substantial dividends. Reinvesting those dividends allows you to compound your returns and increase your position over time. Fourth, be patient. This trade will not work immediately. There will be volatility. There will be periods of underperformance. But if the thesis is correct, patience will be rewarded. Fifth, ignore the noise. The financial media is constantly negative on energy stocks. ESG advocates will criticize you for owning fossil fuel companies. Well-meaning friends will tell you that energy is a dying industry. Tune it all out. Focus on the fundamentals. Follow the cash. Let me close with why I think energy is the opportunity of the decade. Markets go through cycles of euphoria and despair. At the peak of euphoria, assets are priced for perfection. At the trough of despair, assets are priced for disaster. The best investment opportunities come from buying at the trough of despair. Energy stocks are at the trough of despair. Investors have fled. Valuations are depressed. Sentiment is terrible. This is exactly when I want to buy. The fundamentals support the thesis. Demand is growing. Supply is constrained. Cash flows are massive. Balance sheets are strong. Valuations are cheap. The pieces are in place for a substantial repricing. I have seen this setup before in the late 1990s. Everyone hated value stocks and loved technology. Value stocks went on to massively outperform in the 2000s. In 2016, everyone hated energy stocks after the oil price crash. Energy stocks doubled over the next 2 years. History does not repeat, but it rhymes. The setup today is similar to those past opportunities. A sector that has underperformed, where sentiment is terrible, where valuations are cheap, where the fundamentals are improving. These are the conditions that precede major rallies. I am loading up on energy stocks before 2027 because I believe we are at an inflection point. The next 3 to 5 years could see energy stocks double or triple from current levels. Not because of speculation or momentum, because of fundamentals and valuations. This is not a popular opinion. Most investors have written off energy stocks. They think the energy transition will make fossil fuels obsolete. They think ESG considerations preclude owning oil and gas companies. They think the best days of the energy industry are behind it. I disagree. I think the best days of energy stock returns are ahead of us. I think the market has overcorrected. I think valuations are disconnected from reality. And I think investors who buy now will be richly rewarded. That is why I am loading up on energy before 2027. That is why I think this is the opportunity of the decade. And that is why I believe patient investors who act now will look back on this period as the moment that made their financial future. The opportunity is here. The fundamentals are aligned. The valuations are compelling. The only question is whether you have the conviction to act when everyone else is selling. I know I do.